So as soon as we understood the seriousness of COVID-19, we invoked our business continuity plan. That was invoked in mid-March, which means that all of our staff are working from home. And I've been very pleasantly surprised about how well everything's working. And somewhat gratifyingly, despite obviously some declines in assets as a result of market falls in the first quarter, we actually had net inflows as we saw a number of clients increasing their allocation to us during the quarter. So all in all, the business is in robust health, the staff are working well from home, it all seems to be working fairly seamlessly at this moment. COVID-19 has not changed our investment philosophy or style. What it has done is it's led us to some tactical changes within the portfolio as we've taken advantage of some opportunities that have arisen. Fortunately, we came into the year with around 8 to 9% in cash. The maximum we can hold is 10%. And so we used the declines that we saw in mid-March to invest within the portfolio and take advantage of some of those declines in very high quality companies where their share prices have declined substantially. And so tactically, we have changed our approach over the last 4 months, but from a philosophical point of view, it remains exactly the same. Our investment philosophy is to invest in high quality companies that are very cash generative with typically strong balance sheets and buy them when they're attractively valued. And these companies tend to outperform in difficult market periods or difficult economic periods. And that's been largely what we've seen during this COVID-related crisis. If we look at the results for the first quarter, the portfolio was down 12.8% for the quarter. Which can be compared against the MSCI World Equity Index, which was down 16%. If we then roll that forward to the end of April, and markets rallied pretty substantially in April, the market was down 8.6% for the year to the end of April, and the portfolio was down 5.7% to the year to the end of April. So again, pretty marked outperformance to the end of April. So our companies have been very resilient in terms of the way they perform. And that's because they are high quality and cash generative, and other investors tend to be reluctant to sell them in difficult periods. We haven't sold any stocks as a consequence of the COVID-19 crisis. Earlier in the year we did sell Rolls-Royce, but that was on company-specific worries related to their Trent XWB engine. So we haven't sold anything as a consequence of the COVID-19, and instead we've been investing our excess cash through this crisis. During March, we saw share prices of lots of companies decline substantially, and the selling was pretty indiscriminate. That gave us the opportunity to deploy the cash that we held in the portfolio, because we saw some very high quality names where the share prices fell substantially. We bought 3 new positions in the portfolio during the first 3 months. All of those positions were bought in the depths of the COVID crisis during March, and they are Raytheon, MasterCard and Baxter. So 3 very high quality companies where the share prices declined substantially. We also used the declines in some of our existing holdings to increase those positions. So we've got a number of positions within the portfolio where the share prices fell much more than we felt the intrinsic value had fallen. And so we used that opportunity to increase those positions somewhat. In terms of outlook for the rest of the year, it really is very difficult to say. Our base case for COVID-19 is that the summer sees the disease regress, so we see fewer cases of the disease, we see less of an impact in the developed markets, and so we see some sort of recovery towards the end of Q2, and probably through the first part of Q3, so through the summer we think there will be something of a recovery. It's likely though that this disease comes back in the autumn, although we do believe by the autumn that health authorities will be better set up to cope. There will be better treatments, so there's a number of treatments that are being trialled at the moment, some of which do show some good promise. So we think that the return of the disease later in this year probably won't be quite as impactful as it has been in the first quarter of this year. In terms of a vaccine, we're less hopeful perhaps than most. We think there will be some pretty effective treatments for COVID-19, but we don't think a vaccine is likely until late 2021, simply due to the safety issues that come around with mass vaccination. So overall, we think there will be recovery in Q2, Q3, some return of the virus in early Q4, late Q3, and an overall a weak period economically. The companies within the portfolio with the strongest potential for return are the aerospace companies. We hold in particular Safran, which is an aerospace engine manufacturer, and Airbus, which is one of the two airframe manufacturers. And we hold another couple of positions that are aerospace related, Raytheon, which owns a number of aerospace businesses, and AENA, which is the Spanish monopoly airports operator. And it's those companies that have been hit hardest by COVID-19, with travel bans around the world. Obviously there are very, very few planes in the air. And this means that the aerospace industry has been severely impacted. The intrinsic value of Airbus and Safran in particular have been impacted. But we believe that the share price has been impacted more than the intrinsic value has, and so we believe that they show a lot of value, and we could see these companies performing extremely well over the next 3 to 4 years if, as we believe, air traffic returns to 2019 levels by 2024. So we think there will be a gradual recovery in air travel, and we will see these companies perform very strongly. Perhaps perversely, the stocks that we are most concerned about in the portfolio are the aerospace stocks. So whilst they have the highest potential for return within the portfolio, they also have the highest potential to disappoint, and so we're most concerned about within the portfolio. Really this comes down to the recovery within air travel for our holdings such as Airbus, the airframe manufacturer, and Safran, which is an aerospace engine manufacturer. Our base case assumes that we see traffic recover to 2019 levels by around 2024. But if this is not the case, and passengers are reluctant to travel, if maybe there's no vaccine developed so travel is curtailed, then we do believe that these companies could be severely impaired if we don't see a return to the levels of travel and traffic that we've historically seen. So clearly there is risk associated with these positions. But our base case is that these companies remain extremely attractively valued. We think that they have good returns ahead of them over the next 3 to 4 years. But there is this outside risk that people decide not to travel, and certainly not by plane, for 4, 5, 6 years if no vaccine is developed. And clearly that's a risk for these companies.